What's going on, y'all? Welcome back to the Playbook Small Carrier Market Update, where we're going to break down what's actually moving in the freight market right now. I'm not here to throw theory at you. I'm here to help you figure out what decisions to make with your truck this week, not next quarter. So I want to start by giving a few insights before we really dig into it, because I want to add a different layer of information in the small carrier market update, just that you're well informed and stay ahead of the curve when it comes down to it. So I want to just get off and just start off with just a few buckets. The first one I want to talk about is I went back and I took a look at the trucking employment as a whole. And just from the data that we see that trucking jobs remain flat in May, but overall, general freight showed a slight decline, especially in the local and long haul segments. But we did see payroll earnings hit record highs in April, but that's only for W-2 employees. That's not for your small carriers and your owner ops out there. So if you're feeling that record income or you're feeling that lift, you're not crazy. The environment is just hitting a little different for independents as a whole. We also saw diesel prices this week impact us in a negative way. Obviously, they went up 10 cents since June 9th to 357 a gallon. This is the second week of price increases. You got to stay ahead of that because with the Israel and Iran tension, we've seen spikes before when crude gets rattled, and this could be the start of something very, very volatile. So I really want you to be mindful of what to expect and really keep an eye on what's happening because that can definitely change the environment as a whole. What we see in the spot market activity, we've seen spot market metrics follow a normal post Memorial Day cool down. Typically, right after the holiday, we do get that cool down. Loads are down across most equipment types, but flatbeds is holding a little bit stronger when it comes down to reefer. Dry van rates are up just a little over 1.5%. We'll get into that here in a second, but I just wanted to kind of give you a high level insight on as to what that looks like as a whole. But let's dig into what I love to see and let's start off and let's talk about our weekly data as we go from week to week. First, let's dig into the National Truckload Index. And as you can see, we've had a soft slide. We're now sitting at 225 when it comes down to overall National Truckload Index. And this is a 7-day rolling average, not what we want to see in terms of overall rates. It's trending down from they had a late spike in May, and we're trending downward from that late spike. And that soft slide just means that spot rates are still unstable. This post blitz week high that we had was short lived. And if we're holding out for those $2.50 lanes, you're gonna need to rethink your strategy as we're going through the holiday because I just don't see it. We just don't have anything that jumps on the page that really kind of speaks to that. So I want to make sure that we're prepared for that. Now, when I look down into the outbound tender rejection index, we're down to 5.81. And what that means is obviously that your contract carriers, they are eating 94% of the freight. Less spillover onto the spot market means fewer higher paying loads. So this is where it's really, really important where your trends are going. You know that as far as charts, this is one of my favorite charts to really cover because this chart truly gives you an idea and a mechanism on what you can expect in terms of rates. So right now, what your contract carrier is eating 94%, then that means small carriers are fighting over that less than 6%. And that is a tough marketplace when it comes down to it. So I definitely want you to make sure that you're aware when it comes down to it, because I really, really believe that if you look at the tender rejection index, that's going to give you an insight as what the market's going to do. It gives you that understanding on what to expect. So I really want to make sure that we honed in on this particular component of it because it's really important. Now, we did see some positive, okay? And the positive that we saw is we saw the outbound tender volume index slightly increase. Now here, flat is better than falling. You know, the seeing that we have increased just a slight hair to 10,503. This gives us hope that we're not sliding into a deeper demand slump, but we need to keep an eye on post 4th of July volume. That's what I really, really want to see. It's probably one that I'm going to pay the closest attention to because I really think that that volume is going to really tell us where we're going, tell us what to expect as we move forward. So that's one to keep our eyes on as we move in past the holiday. And I think that that's really, really important to really kind of lay out.
The super successful people are part of the 1%. They're part of that very, very small percentage. That's why I don't want you to do things that everybody's doing. I want you to do the small things that nobody else is doing. The people that are most successful in this business treat it like it's the only thing that's bringing income into their household. If you do that, then you'll have the same results. The people that I see most successful in this business operate like they have no other chance. They have nothing else going. This is the only breadwinner that they have in play. I'm Adam Wingfield, and this is the Freight Waste Playbook.
Then when I look at the heat map, man, position is all key. And honestly, this is where it's most important to really understand what position it is. You got some red pockets out here in Northwest and Texas, and you got some blue pockets otherwise in the Northeast. You got some blue out in the Midwest. You got some blue somewhere in that mid-Atlantic as well. Positioning is key. Now, what you're seeing on the screen right now, these are your spot rate changes over the last 4 days. And I'm going to assume that you're new to this particular segment, so I'm going to explain what you're seeing. Blue means that those spot rate changes have improved. Red means that they've gotten worse. So as you can look on this particular map, you can see that, hey, if I'm operating this week, just looking over the last 4 days, if I'm operating in the blue, I've got a better opportunity to secure better return freight, a better opportunity not to get stuck because these particular areas have higher rates. If I put myself into a marketplace in red, that is a dangerous place to be. Make sure that you don't stick yourself in a place that's just specifically red unless you got a true strategy, or maybe that's hometown for you. I don't know. Maybe that's some place that you call home. But we got to make sure that we're very key about that and don't deadhead into those red zones just because you can get paid higher on the front end. So it's super important that you do that, because without that, that's going to really showcase a really big slide if you get in those areas and not able to navigate through. So make sure that you're paying attention to that. I really like that chart because it's a good chart to follow through with. So here's a couple of strategic reminders that I wanted to provide you with. Number one, when you want to run blue to blue. You want to look at volume and rejection rate, and you want to go with volume and rejection rate. Where you see volumes improve and rejection rates improve, that's when you're going to know that you're in a good marketplace and in terms of the entire market as a whole. Number two, I would stack my lanes, right? So I'm pairing my lanes together. Remember last week we talked about Savannah to Baltimore? Well, if you're trying to get back to Savannah, instead of going Savannah to Baltimore and Baltimore back to Savannah, go Savannah to Baltimore, maybe Baltimore over to Pittsburgh, then Pittsburgh back. Having those triangle markets are really important because you'll add additional revenue in the overall trip at the same time. Now, you got to consider fuel too, because we talked about fuel prices where they were and the importance of understanding where they're at in terms of fuel prices. And I thought that from a fuel pricing perspective, it's really volatile right now. So it's important to understand that we're doing that. Now, one of the things that I make sure too is that you monitor that diesel and you take a look at your break even. Every 7 days, you need to be recalculating your break even using the calculator that we're providing or using your own type of strategy, but your business is constantly evolving. Make sure you're doing it every 7 days. With this fuel shifting the way it is and fuel being your biggest variable expense, make sure you recalibrate and recalculating that every 7 days. Now, for the short term, here's what I expect from outlook. Number one, I expect a seasonal volume bump heading into the 4th of July. Happens every year. It's just one of those things we can expect. But like I said earlier, we need to see what happens on the backside of that seasonal bump. Number two, I don't think there's going to be a massive rate surge, right? So if you look since April, we've been hovering around the same. We're at 220, we were 221 in April. Now we're 225. So if you look at the last 3 months, we haven't improved a whole lot when it comes down to it. And there's nothing in the pipeline that really makes us feel like that's going to take place. So let's be sure that we're not focusing on those big wins, but look at those tighter markets that you see, the blue to blues that you can get out there and really showcase some really wins that you can win on. So make sure that you're doing that as well. So when it comes down to that, I think that that's a really key call out when it comes down to do it. And I really wanted to focus on that. Now, one of the things that I did want to show you is I wanted to show you the net change. And the thing is that within that net change, I think that's really important in net change, because now we can actually see what carriers are doing. We can see carriers as they exit, and we can see what's being added into the marketplace. So as you can see, as of right now, we've lost 115 carriers over this period, which is telling us that when it comes to a supply and demand perspective, which is very important, being in the red is not necessarily a bad thing for the current market based on what we have available in terms of volume. I hate to say it like that, but it's the truth. It's like having a crowded kitchen with a bunch of chefs and not a lot of things to do. So here's what brings balance back when your supply and demand comes out of balance. It's really important to focus on that. So we're back in the red. We're showing more carriers are shutting down and starting up. This matters because shrinking supply does help balance the market back slowly but surely. So really, really important to consider that. And that's what I wanted to make sure that we had some visibility on today. All right, y'all. That's the update. Every week you got two choices. You can either react to the market or plan forward. Use these numbers to run smarter, not harder. I'll see you next week with more data, more strategy. Until then, keep your numbers tight, your fuel in check, and your freight profitable. Take care, everybody.